Hello friends, thanks for joining me today. My name is John Payne, Senior Market Analyst at Daniels Trading in Chicago. I'm here to talk about a soybean hedge idea that we've had kicking around our trade desk here as soybeans have rallied the last couple of days and might be a time to look to manage a little risk on the rally. So presented here an idea. We're going to try to break it down in video using some tools that we have to help kind of explain what's going to happen to the hedge account at certain prices, so you have an idea of the kind of capital that's needed for a position like this, and get ironed out all the expectations that might prevent you from doing a trade like this. So if you like having these kind of trades explained to you this way, this is something we specialize in. So feel free to give us a call. You can reach any of us here at Daniels Ag at 800-800-3840. Always have the flexibility to use the board wherever you choose it, and that's kind of what we're trying to do here, give you guys flexibility. So we'll get to the trade. As of the close of today is when I wrote this and we're doing this video, so it's April 13th. November soybeans are trading at 968. So the trade recommendation that we're looking at is the 920 put versus the 1020 call in November soybeans. So it's a combo or a collar strategy, which involves buying a downside put, which puts a floor in the market, and selling an upside call, which essentially you take premium from the market, and essentially what you're saying is I'm going to sell the board if it gets to 1020. Now, essentially what we're doing is we're going to take that premium at 1020 and apply it to the put at 920, so we have a floor in at 920. So on expiration, it's pretty straightforward. If we're above 1020, the hedge account gets marked to market versus anything above 1020. If we're below 920, you're going to make mark to market every single cent below 920. We all understand that. That's pretty straightforward. But what we want to talk about is what's going to happen to the hedge account hypothetically based on a price move. All right, so what we're going to do is use Option Source. All right, Option Source, if you've never heard of it, is a kind of a theoretical option trading software that will allow us to, calculate option spread profitability based off of where prices go when. So it takes a little bit of the mystery out of what the position is going to be losing or making you if the prices would spike or sell off rather rapidly. So we'll get right to it. Before you start, I think it's important you need to note that this is, like I said, for a producer who is either long grain in the fields or long grain in the bin. So when you see this strategy here, it's bearishly biased. It's going to make you money if the market goes down in the hedge account and lose you money if market goes up in the hedge account. Now, early in the trade, it's going to very closely mimic a futures account, meaning as the market moves higher, your hedge and your margin is going to reflect like if it was a futures trade. So if we're above 960, 970, the market's going to show losses in the hedge account. So as you can see here, real quick, we'll get to the graph. The x-axis represents price. The y-axis represents the theoretical profit and loss that you'll see in the hedge account. All right, so this doesn't factor in the corn or the soybeans. Soybeans that will be appreciating as prices rally. Simply just reflect the profit and loss in the hedge account. Each line represents a different day of the trade. So each line right now on the way have it set up is differentiated by 2 months. This straight line is today. No matter where we are on the curve, wherever we cross this line at a certain price point, if we go to $10 tomorrow, we're down 25 cents on the hedge. If we go to 10.20 tomorrow, we're down 40 cents on the hedge. All right. Now keep in mind, if we go to $10 tomorrow, you will have made 32 cents on the grain. So we will have lost 25 cents on the hedge approximately, but you will have made 32 cents approximately on the grain difference. So you're up 7 cents. But with what we like about this trade is that it allows, as time goes on, it's going to allow flexibility to the upside so that you're going to make more money as the grain rallies. And vice versa, you won't make as much money on the downside as grain sells off. So in the short term, like I said before, if we go down to $9, this hedge is going to be worth close to 40 cents profit. Whereas if, say on expiration, if it goes to $9, it's only worth about 20 cents of profit. All right, so you got to keep that in mind. Time is a factor here. So as we get closer to the end of the time frame, the trade is going to reflect a real wide profitability and loss based off of where we trade. So as you can see here with this straight line, it doesn't matter where we are between 920 and 1020, you don't lose a dime before commissions and fees, because we will have collected 3/4 cents on the trade. All right, so something to keep in mind. This is a marginal trade with unlimited risk. I got to make sure I touch on that, because you're selling a call option. You are exposed to risk that can be very painful. If this thing trades back up to where we were in 2012, and you're trading $15 soybeans, your soybeans that the hedge represents will be worth a lot more money but your hedge account will reflect losses as well. So it's important to keep that in mind. That this is not a panacea. It's not a perfect trade. It doesn't allow you upside potential with 100% downside protection. That doesn't exist. What it does offer is a floor at 920 and a ceiling at 1020 on expiration. If you go to a banker, or you can keep this trade liquid up until then and then sell your beans higher, everything should wash out with losses being taken above 1020 and profits being taken below 920. Hope this makes sense, everybody. If you have any questions or want to, have any other ideas that you want to throw at us, we'd be happy to touch on them in these videos. We're always looking for content and for you to be a part of it. So I hope this did a good job setting expectations. If you need anything, feel free to call the desk here at Daniel Zag at 800-800-3840. Thanks a lot for joining me today. Have a good one.